Welcome to the Deep Dive, where we cut through the noise and get straight to the insights that matter. Today, we're plunging into a truly bold and, frankly, pretty disquieting forecast. It comes from renowned macro analyst and former banker Alasdair MacLeod. He makes this profound claim that we're staring down a financial collapse worse than 1929, signaling nothing less than, well, the end of the fiat currency
Yeah.
system. That's a huge claim, almost unthinkable, really, in our modern financial world. So, our mission for this deep dive is to unpack exactly what McLeod means. We're drawing primarily from his recent interview on the Reinvent Money YouTube channel. We're going to try and extract the most important nuggets of knowledge here, thinking about the risks of credit and fiat money, where we actually are in this debt cycle, and maybe explore what a new financial system might look like, and, without getting totally bogged down in the complexity. So let's unpack this. McLeod asserts that the current credit bubble is way more extreme than even the one that birthed back in 1929. What's the core reason, the tangible thing that makes this different? Or, maybe more fragile than those historical parallels? Why potentially worse than the Great Depression?
It's a really crucial question because, look, to understand why it might be worse, you first have to grasp what a credit bubble even is. When you're inside one, everything feels, well, wonderful, doesn't it? Asset values are soaring. People are chasing momentum stocks, not value because, well, why bother with value when momentum seems to be making everyone rich?
Right. Easy money.
Exactly. But the flip side of all that credit is, of course, debt. And we are undeniably in the largest debt and credit bubble in recorded history. And just to put a fine point on it, NASDAQ U margin debt alone, it's now over $1 trillion.
Wow.
It has never been this high. Now, you compare that to the Roaring '20s, which, hit reality hard in September 1929. That historical credit bubble, it ultimately led to the American stock market collapsing by nearly 90%.
90%. That NASDAQ Q margin debt number, that really underlines the scale we're talking about today. But beyond just the credit bubble itself, McLeod also draws another historical parallel, doesn't he? Specifically around trade policy. He mentions the 1930s, the infamous Smoot-Hawley Tariff Act. Can you just remind us briefly what that was and how he argues we're seeing an echo of it now?
Sure. So Smoot-Hawley, back in 1930, it introduced these really indiscriminate tariffs, not just on consumer goods, but intermediate goods, even some commodities. It was this broad brush protectionism that basically just choked off global trade.
Okay.
And today, McLeod points to recent tariff policies, and he actually calls them Smoot-Hawley Mach 2.
Mach 2. So if that's the case, why is this current version considered potentially even worse than the original back then?
Well, because the U.S. economy today is just far less contained than it was in 1930. Back then, the proportion of GDP that relied on imports, it was considerably less than 10%.
Right, much more self-sufficient.
Yeah, much more. Today, it's vastly higher. I mean, we've spent decades building these incredibly intricate global supply chains that are now actively being dismantled. And on top of that, you've got this significant geopolitical shift happening. You have, in his words, over 70% of the world's population forming a line behind China and Russia, while the West, as he sees it, is kind of in self-destruct mode with these policies. The rest of the world is actively trying to, protect itself from the fallout.
Okay, this brings us to what McLeod sees as the most critical distinction then.
Yeah.
If the credit bubble's bigger and the trade wars are echoing the past, what's the fundamental difference between 1929 and now that makes this situation, in his view, potentially more catastrophic?
Right. So in 1929, you had the gold standard.
Yeah.
That provided a kind of escape, you could say. Even if banks went bust, asset values collapsed. The value of the dollar itself was ultimately guaranteed by gold. There was a solid, tangible anchor this time. There's no gold standard. There is no escape like that. Without that anchor, the currencies themselves, they're destined to collapse. And this is precisely why McLeod believes it's actually worse than 1929. The fiat currency era, he basically argues, is just coming to an inevitable end.
That's a stark difference. But, some might argue that the flexibility of fiat currency systems, that actually allows for more agile policy responses in a crisis. It avoids the rigidity of the gold standard, right? How does McLeod respond to that?
He argues that the very nature of fiat currency, precisely because it allows governments to act to to print money and expand credit without real tangible constraints, that's what ultimately leads to this inevitable collapse. That flexibility, it becomes its undoing. And it's not just the currencies. This problem is intrinsically linked to another massive bubble that's maybe often overlooked.
Which is?
Derivatives.
Ah, right. So the end of the fiat era is tied to what he calls the end of the derivative era. How has this huge derivatives market contributed to the situation we're in?
Exactly. I mean, the derivatives market has just ballooned, particularly since the 1980s. And the West has effectively used derivatives to suppress commodity prices. They do this by increasing what he calls artificial supply.
Artificial supply. So
Uh-huh.
basically, creating supply on paper that doesn't actually exist physically, keeping real prices down. And now that's unraveling.
Precisely. And China, notably, has benefited enormously from these suppressed prices. They've been able to accumulate huge quantities of silver, gold, platinum, palladium, copper, you name it.
Hmm.
But now, they're no longer feeding these physical stocks back into the market. They're holding on to them, which means the physical liquidity that these derivative markets absolutely depend on, it's disappearing.
Right.
And that leads to a potential massive squeeze on the system. It's like a game of musical chairs, and the actual physical chairs are just being pulled away one by one.
That musical chairs analogy is quite vivid. So for listeners, what's the sort of immediate practical implication of that physical liquidity vanishing? Are we talking price volatility, supply shocks, or something more fundamental for, the average person?
It means we could be looking at a really significant supply crunch in real physical stuff, commodities, with prices potentially exploding as a result, completely separate from what's happening in the paper derivatives market.
Hmm.
It's physical reality kind of reasserting itself over those paper promises.
Okay.
And we've even seen central banks themselves contributing to this, haven't we? Repatriating their gold. Serbia, for instance, has brought back 95% of its gold. Hungary, 75%. Germany, the Netherlands. They've also pulled significant gold reserves back from major liquidity centers like London and New York.
So these moves by central banks, they're not just about, say, financial prudence. They're maybe a clearer signal of strategic positioning, preparing for a fundamentally different global financial landscape, one less reliant on the West.
Oh, absolutely. It's definitely strategic. They're positioning themselves for a very different future.
Okay, so given all this, can central banks still just kick the can down the road, like they did in previous crises? Lehman, Silicon Valley Bank last year. Can they just expand credit further to rescue the system again?
Well, they absolutely can, and McLeod is quite clear they will try. The expectation is that the Fed could easily, say, triple their balance sheet, and you'd see other G7 central banks doing the same.
Right.
The mechanism is almost deceptively simple.
Mm-hmm.
Central banks buy up bad debts at face value from commercial banks. They effectively hide the losses on their own balance sheets,
By
creating credit literally out of thin air.
Okay, but this strategy of kicking the can, it's worked before, yes, but McLeod seems to be saying the cost this time is fundamentally different. What is that cost going to be for the average person, beyond just abstract numbers?
The cost is a real acceleration in the quantity of currency. He says it's going to explode. Now, you combine that explosion of currency with ballooning government deficits, falling tax revenues, rising welfare payments. You're looking at a catastrophe which can only result in the collapse of the currencies. This, he says, this is the mother of all bubbles and crashes. And what does that mean practically? Interest rates, specifically bond yields, will go through the roof. He predicts the 10-year U.S. Treasury note going through 5% very, very quickly. He even recalls the UK having 15% plus bond yield back in the 1970s.
15%?
Yeah. And this means all those zombie companies, the ones that loaded up on debt when rates were ultra low, they'll go bust. That leads to a banking system collapse, which, guess what? Central banks will then try to rescue through even more currency inflation. It's a vicious cycle.
Can they prevent those long-term yields from rising, though? Maybe through something like yield curve control, like we've seen in Japan where they try to pin long-term rates at a certain level.
McLeod is pretty adamant. They can't prevent it. They cannot control the long end of the yield curve indefinitely. And there's a critical flaw baked into the system that makes it worse. You see, Basel III.
The international banking regulation.
Exactly. Basel III assumes government debt is essentially risk-free, which he just calls the biggest joke in economics.
Right. So a core assumption underpinning global banking is just flawed, treating government debt as zero risk when it clearly isn't, especially now.
Precisely. It's a fundamental miscalculation. And the institutions that are forced by regulators to buy this long-term debt, like pension funds and insurance companies, they're simply not big enough to absorb this problem. There aren't enough buyers for the sheer volume of debt that needs financing if rates rise significantly.
Okay, if that's the case, what does this imply for other asset classes? particularly the stock market? Is the bull run we've seen pretty much destined to reverse course?
Well, the specific trigger to watch, according to McLeod, is that 10-year U.S. Treasury yield. If it goes above, say, 4.7% or 4.8%, if it breaks through that level, he says it's kiss goodbye to the bull market in equities. Done. Apparently, the relationship between equities and bonds right now is already twice as stretched in valuation terms as it was even during the peak of the dot-com bubble.
Twice as stretched.
Yeah. So rising bond yields make stocks look much less attractive. Plus, remember that $1 trillion in U.S. margin debt?
Right, the leverage.
That will trigger margin calls, forced selling,
Right.
which just exacerbates any collapse. It feeds on itself.
Okay, so stocks look vulnerable. What about some of the newer alternatives? Things like stablecoins or even central bank digital currencies, CBDCs. Many suggest these could be part of a solution, maybe a path to a more stable digital financial future.
McLeod is pretty dismissive. He calls stablecoins and CBDCs essentially rubbish and flatly states they are not going to work. For Western CBDCs specifically, he thinks they would take, 10, 15, 20 years for government committees to even figure out how to implement them.
Right, bureaucracy.
Yeah, and the U.S. has actually legislatively banned the Fed from CBDCs. And his point is, if America doesn't do it, nobody else will do it, at least not in the West.
Okay. What about crypto then? Specifically Bitcoin. Many see that as a genuinely decentralized alternative, a hedge against fiat currency failure, digital gold even.
Yeah, he addresses that. He basically correlates Bitcoin's price movement with the Mag 7 tech stocks, the big tech giants. He argues it has no assets, no business, and it's just got a concept. He asserts that for most investors, Bitcoin isn't really seen as an alternative to fiat currency. It's treated more like a speculative asset.
That's a strong dismissal, though. I mean, many Bitcoin proponents would argue its core design, decentralized, fixed supply, makes it inherently different from fiat. It's designed precisely as a hedge against the kind of currency collapse you've been describing. How does he reconcile that view?
His perspective seems to be more legalistic and market-focused in the short term. He believes that when the credit bubble properly pops, crypto will simply be wiped out completely. Why? Because in his view, it cannot be legally money. He's also quite critical of policies that have promoted crypto, likening the timing to the Fed's historically exquisite timing from the point of view of screwing things up.
Okay, so if fiat currencies are potentially collapsing, and he sees these other popular alternatives like CBDCs and crypto as not viable, what is the only answer then, in McLeod's view, for a functional financial system going forward?
He believes the only answer is ultimately the legal one, which means tying the value of credit back to corporeal money, real physical money.
Meaning gold.
Meaning gold.
Yeah.
Because it has no counterparty risk. Now, he's not saying gold itself will circulate widely in daily transactions like coins, but credit, the basis of the financial system, needs to be tied to it, anchored to it, to restore stability and trust.
And how does China fit into this picture, particularly with its own currency, the yuan, and its very visible strategic accumulation of gold?
Well, China's plan, as McLeod sees it, to move towards a gold standard is fundamentally a defensive move. It's about protecting its own currency from the dollar's eventual inevitable collapse. We're actually seeing the beginnings of an oil to yuan to gold exchange standard emerge.
How so?
China's opening Shanghai gold exchange vaults in places like Hong Kong and even Saudi Arabia. Russia is apparently ready to adopt a gold standard too, but is essentially waiting for China to make the first major move. This whole movement is actively creating a new world financial system, really, away from the West. China is encouraging other nations to band together on trade and using a settlement currency that's ultimately backed by or convertible into gold.
That's a potentially profound shift in global financial power. If this scenario unfolds, what does he see happening to Western currencies, especially something like the euro, which is, relatively young compared to the dollar or the pound?
He predicts Western currencies like the pound and the dollar will dramatically lose purchasing power. They'll eventually buy absolutely nothing in terms of real goods and services. But interestingly, they'll likely still be used for day-to-day transactions domestically. He draws an analogy to Venezuela and the bolivar today used locally, but worthless internationally.
Okay.
The euro, however, that's identified as potentially the least likely to survive this crash in its current form.
Why the euro specifically?
Because it's only existed since 2000, really. And there's still this lingering memory, particularly in core countries, of the previous national currencies, like the Deutschmark in Germany. This makes it uniquely vulnerable if the system fractures. He suggests countries like Germany, Hungary, the Netherlands, They may even have backup plans already for a potential return to national currencies.
And Poland. Their recent gold buying and refusal to join the euro seems significant in that light.
Very strategic moves, yes.
Yeah.
Seen entirely in that context. They're preparing.
It sounds like, beyond just changing the monetary system, McLeod believes there's a much deeper shift required for any kind of real sustainable recovery.
Oh, absolutely. He suggests that any real monetary change, any lasting fix, demands nothing less than a cultural change. A fundamental shift in how governments operate, moving away from just endlessly wasting financial resources.
So it implies a whole philosophical reevaluation of public spending, of government intervention, not just a technical tweak to the money system.
Exactly. It's a huge ask, politically and socially.
Yeah.
But he sees it as absolutely essential for any viable path forward.
That idea of a necessary cultural shift is quite profound. So with such a dramatic, even alarming outlook, what practical advice does McLeod offer? For you, the listener, trying to navigate what he literally describes as a potential tsunami of financial events. It's easy to get lost in the macro picture, but what does this mean for everyday life?
Well, his advice is pretty direct. For the middle classes, the focus needs to radically shift. It's no longer about increasing their wealth, it's about protecting it. Purely defensive.
And how do you do that?
The primary way, he says, is to get the hell out of credit. Reduce your exposure to debt in all its forms. But beyond just personal protection, he also stresses the importance of thinking about your community. Because, as he puts it, this is not going to be easy for anyone. Oh, do. His closing advice is stark, but it feels urgent. Whatever you can do to protect yourself and those around you, it is extremely important, he adds. And you may disagree, but for goodness sake, think about it seriously. It's desperately important.
So we've journeyed through McLeod's compelling and, yeah, definitely challenging vision today. We've touched on everything from a looming credit bubble, potentially worse than 1929, the possible end of the entire fiat currency system as we know it, to a predicted New World Order potentially anchored by gold, centered more towards the East. It's clear, listening to him, that the current financial system faces, well, unprecedented risks, risks that could lead to a really profound transformation of global currencies and markets. And this raises, I think, an important question for all of us. If the very foundations of our financial system might be shifting beneath our feet, what does security truly mean for you in this rapidly changing landscape? And how might you need to redefine your relationship, not just with wealth, but maybe with your community in the face of such potential change? We definitely encourage you to consider these ideas, do your own research, of course, and continue your own deep dive into understanding what might be coming next. You can find more insights directly from Alistair McLeod on his Substack, that's mcleodfinance.com, or alistairmcleod.substack.com. Thanks for joining us on the Deep Dive.